Welcome, curious minds, to another deep dive crafted just for you. We're about to embark on a journey that, well, on the surface, might seem to be all about cold, hard numbers, complex charts, and meticulous spreadsheets. But trust me, as we peel back the layers, you'll discover it's far more fascinating and, dare I say, deeply human. Our mission today isn't just to, unravel the financial storms, but to equip you with the mental tools, the building blocks for your own financial seawall to navigate these emotional tides effectively.
It's a pleasure to be here. For most people, finance often conjures images of purely rational decisions and economic models. But with over a decade in financial psychology, I've seen firsthand how money, at its core, is profoundly psychological. It's really about our minds, our emotions, and the very human nature we bring to every single financial choice.
Right. And today we're plunging into The Investor's Mind, a masterclass on market psychology, Gen Z investing. We'll explore how our brains, our emotions, and even our deeply intertwined digital environments are shaping our financial futures. And we'll have a special, crucial lens on the unique experiences of Gen Z.
Exactly. Yeah. You might be sitting there thinking, well, my financial decisions are always rational, aren't they? Mm-mm. Well, we're here to gently challenge that assumption just a bit. From the smallest impulse buy to the largest investment decision, our psychology is at play far more than we often realize. Think about that gut feeling you get before a major purchase, right? Or the undeniable anxiety that washes over you when the market dips. That's your psychology in action. And for Gen Z, this whole journey is even more intricately woven into the digital world. Influences are constant, often unseen, and frankly, incredibly pervasive.
We've gathered a truly fascinating stack of research for this deep dive. We're talking insights from Nobel Prize-winning psychologists, modern behavioral economists, even some really eye-opening sociological studies on Gen Z's unique investment habits. Our mission is to extract the most important, often surprising, nuggets of insight. We want to help you understand not just what to do with your money, but fundamentally why you do what you do. It's about getting to the root of your financial self. Okay, let's begin by challenging a long-held assumption. For centuries, traditional economics operated on this premise of homo economicus, this idea that we are all perfectly rational beings, always making optimal decisions to maximize our utility. But the real world, well, as anyone who's ever made a questionable late-night online purchase can attest, tells a vastly different story, doesn't it? It's sort of like assuming every poker player always makes the mathematically perfect move, even when they're bluffing or nervous or just plain tired.
That's a brilliant analogy, actually. The truth is that perfectly rational economic agent, it's pretty much a myth. Behavioral finance is this groundbreaking field that blends psychology with economics, and it decisively shows that investors and humans in general aren't always rational, not even close sometimes. We have inherent limits to our self-control, our cognitive processing power, and we are profoundly influenced by our own biases. It's a complete and, frankly, much-needed challenge to the idea that humans always act with perfect logic to maximize their utility. We're just far more complex, driven by this messy, wonderful mix of logic and emotion.
And this isn't just some quirky academic theory tucked away in a journal somewhere. It's earned some truly serious recognition. It's fundamentally shifted how we understand decision-making and even wealth creation.
Oh, indeed. The impact has been monumental. Daniel Kahneman, a psychologist, was awarded the 2002 Nobel Prize in Economic Sciences, along with Amos Tversky, for their seminal work in behavioral finance. They didn't just tweak the old rational model. They fundamentally, shattered it. Their research proved, with compelling evidence, that our brains systematically process randomness in peculiar ways. We selectively perceive data to fit existing narratives and often create artificial storylines just to make sense of otherwise incomprehensible information. It was truly groundbreaking work, opening the door to a much more realistic and, frankly, more interesting understanding of how we actually behave with money.
So if we're moving away from the idea of finance as physics with its strict, predictable laws, are we moving towards something more like the unpredictable, nuanced world of psychology, where human behavior is the ultimate wild card?
Precisely. As one expert in our sources eloquently puts it, financial success is not a hard science. It's a soft skill where how you behave is more important than what you know. End quote. Think about it. You don't need to study complex interest rate formulas to grasp why people sometimes bury themselves in debt. You need to study things like greed, insecurity, and optimism. Similarly, understanding why investors panic and sell out at the very bottom of a bear market. That requires thinking about the agony of potentially imperiling your family's future, that overwhelming fear, not just the cold math of expected returns. It's all about the psychology of money, and it reveals a truth far more profound than any spreadsheet ever could.
That makes so much sense. It really highlights how deeply our personal experiences with money are woven into our financial fabric. They almost seem to overpower objective facts or, stuff we learned. Like, if you grew up during a major recession, that experience might leave this indelible mark, making you far more cautious than someone who only knew economic booms, right?
You've hit on a key insight from our research there. The sources emphasize that your personal experiences with money make up maybe 0.000000001% of what's happened in the world, but maybe 80% of how you think the world works. People from different generations with varied backgrounds and unique life experiences learn vastly different lessons about how the stock market or the broader economy actually functions. And these lessons, often steeped in really strong emotional memory, are so compelling that they frequently override secondhand knowledge. If you personally witnessed your parents struggle during a market crash, that emotional imprint is likely far, far stronger than any textbook lesson on the long-term benefits of diversification. It shapes your entire financial worldview, really.
Okay, now, let's pull back the curtain even further. We've talked about external forces and biases, but the real battle, as our stack of research shows, often plays out right inside our own skulls. Our brains, for all their brilliance and complex capabilities, come preloaded with some fascinating quirks that can lead our financial decisions astray. It's kind of like having a supercomputer with a few delightful, sometimes inconvenient bugs, maybe a tendency to prioritize immediate gratification over long-term stability, even when we know better.
That's a perfect way to describe it. Dan O'Reilly, a prominent professor of behavioral economics, dedicates his work to illuminating these cognitive illusions. They illustrate precisely why humans make predictably irrational decisions. Our brains are essentially wired to create artificial storylines, to connect dots that aren't always really there, simply to help us make sense of otherwise incomprehensible data and impose some kind of order on a chaotic world. And this drive for narrative, it can easily lead us down financially questionable paths.
And this irrationality isn't just a minor glitch or an occasional misstep we make when we're tired or stressed. It seems like it's a fundamental, hardwired part of how our brains handle the interplay between emotions and logic, particularly when we're under pressure. It's not just a bad day for decision-making, it's how our internal systems are designed to react.
Absolutely. The science points to a fascinating and often problematic asymmetry of information processing within our brains. Consider this. The ratio of nerve fibers going from the amygdala, our major processing center for raw emotions like fear and anger, to the neocortex, which is responsible for rational thought, is a staggering 80-20. So when stocks tank and you feel that primal urge to panic sell, that's often your amygdala just taking over, firing off all those fight or flight signals. It effectively overrides the slower, more deliberate processing of your rational neocortex. It's a primal survival response kicking in, even when the threat isn't a saber-toothed tiger, but, a dip in your portfolio.
Wow, 80-20 towards emotion. So does that mean the ideal investor, perfectly rational, patient, calm, calculating is almost a biological impossibility? Are we truly destined to battle against millions of years of evolutionary programming, or is there a way to maybe harness it? That sounds like an incredibly tough fight to win.
That's a fantastic question, and it really cuts to the core of behavioral finance. We're not necessarily destined to lose the battle, but we absolutely must first acknowledge it's an inherent struggle. These desirable traits of patience and pure rationality don't always lie in our nature because our biology predisposes us to certain immediate emotional reactions. Understanding this internal struggle, the very wiring of our brains, is the first crucial step toward building systems and habits that can help us navigate financial decisions more effectively. It's not about becoming emotionless robots. That's impossible. It's about recognizing these inherent tendencies and creating intelligent safeguards against our own primal urges. We learn to work with our biology, not constantly against it.
Right. If investing were purely logical, like you said, everyone would probably be a millionaire. We just follow the numbers, unemotionally execute the trades. But as we just discussed, it's far from it. And at the very heart of this emotional battlefield, constantly pulling us in conflicting directions, are two titans: fear and greed. They're like the little angel and devil on our shoulders, constantly whispering, often with profoundly persuasive voices.
That's a powerful image. Our sources consistently highlight that trading is as much a psychological battle as it is a financial endeavor. These emotions are primary drivers of our decisions, often far more potent than pure logic. We tend to feel positive or negative about something almost immediately, right? And only later do our brains scramble to develop rational-sounding reasons to support that initial visceral feeling. It's the gut feeling dictating the outcome, with the head justification arriving as sort of an afterthought, an attempt to rationalize.
So whether it's that impulse buy you love at the store or a rapid-fire trade in a volatile market, our decisions are often heart-driven first and head-justified second. Like, the allure of those new shoes just feels right, and only then do we construct the narrative of why we absolutely needed them.
Exactly. And this plays out dramatically with something called loss aversion. Research shows that the fear of losing, say, $100, is significantly, demonstrably stronger than the excitement or pleasure of winning $100. This intense aversion to loss can lead investors to hold on to declining investments far, far longer than any rational economic decision would dictate. You simply cannot bring yourself to realize that loss, even if selling is the smartest, most logical move to preserve capital. It's a fundamental psychological hurdle we all face.
And greed, on the other hand, seems almost like the inverse of fear, yet equally destructive potentially. How do these two primal forces truly interact, say, in a bull market? And what's the trickiest aspect for investors trying to navigate that euphoria?
That's a fantastic question. Well, fear paralyzes. Greed can absolutely blind. Greed fuels impulsive decisions and an inflated sense of overconfidence, leading us to chase ever higher returns or to completely ignore critical warnings during market rallies. What's tricky is that in a bull market, greed feels good. It feels like validation, like you've cracked the code. These two emotions, fear and greed, they're really the engine behind the cyclical swings in stock markets, pushing us from optimism to euphoria, then crashing down through anxiety to despair. Mastering charts and strategies is certainly crucial, but truly understanding and controlling these powerful, deeply ingrained emotions is what separates consistent success from costly, repeated mistakes. It's not about eradicating them, which is impossible, but managing their powerful, often deceptive influence.
Okay, let's talk confirmation bias. We're all familiar with it, that deeply human tendency to seek out information that just validates what we already believe. It's like only reading news sources that already agree with your worldview, making you feel, intellectually secure. But what our deep dive into the research stack revealed is how truly insidious it becomes, particularly for Gen Z, when it's amplified by the echo chambers of social media.
You've hit on a crucial distinction there. Confirmation bias is incredibly powerful and a significant, often subtle, contributor to investment mistakes. Investors can become overly confident when they repeatedly receive data that confirms their initial decisions. This creates a false, often dangerously inflated sense that nothing can go wrong. It leaves them profoundly vulnerable to being completely blindsided when new, disconfirming information fundamentally changes the landscape. It's like having blinkers on, but you've actively, perhaps unconsciously, put them on yourself.
So, if I think a certain stock is a guaranteed winner, I'll unconsciously gravitate towards articles, posts, opinions that agree with me, while actively filtering out or dismissing anything that suggests I might be wrong, even if those contradictory pieces are well-reasoned and evidence-based.
Precisely. It's almost physically painful sometimes to read something that challenges your deeply held view, because it directly creates that cognitive dissonance we'll discuss shortly. To minimize this significant risk, you have to actively and consciously challenge your own investment thesis. This means seeking out information that causes you to question why you might be wrong, not just reinforcing why you think you're right. It's about inverting the investment case and continually revisiting your assumptions, especially as new information emerges. This requires a conscious, often uncomfortable effort, but it's vital for intellectual honesty and, financial survival.
And in our modern digital age, with personalized feeds and algorithms constantly curating our content, this bias gets supercharged, doesn't it? It's almost built into the very fabric of our online experience, making it harder than ever to break free.
It absolutely does. Social media algorithms, which are ingeniously designed to maximize engagement and keep you scrolling, constantly feed us content that either reinforces our existing beliefs or subtly triggers our fears. Our sources call this the creation of dangerous feedback loops, which amplify both polarization and paranoia around investment choices. This directly affects decision-making and, in turn, can significantly contribute to market volatility, as we saw with the intense swings of some meme stocks, for example. It's not just about seeking confirmation anymore. It's being actively served to us on a silver platter, making genuine independent research much, much harder.
Right, the idea that losses hurt far more profoundly than gains feel good, that's loss aversion. And it's a concept that really illuminates some of the most puzzling, seemingly irrational behaviors in finance. Like, why would someone stubbornly cling to a clearly failing investment, effectively doubling down on a bad bet, even when all logic screams to cut their losses?
That's the core question, isn't it? And it's a cornerstone of prospect theory, which, as we mentioned, Daniel Kahneman and Amos Tversky developed. People feel the emotional impact of losing money with a significantly greater intensity than the satisfaction of achieving a similarly sized gain. This hardwired asymmetry often leads to irrational decisions, even when the rational path, the one that minimizes future damage, is perfectly clear. It's that primal fight-or-flight response kicking in when facing a potential loss, overriding logical calculations. It just hurts more to lose.
Can you give us a real-world example of how this plays out? Maybe something most people can immediately relate to, even outside the complex world of stock trading.
Absolutely. Real estate investments frequently demonstrate this phenomenon really clearly. Investors often maintain losing investments well beyond the point where portfolio adjustments would be clearly beneficial, simply because they don't want to realize or acknowledge the loss. They're effectively, as the saying goes, harvesting flowers while letting weeds grow, selling their winners prematurely to lock in gains while clinging desperately to their losing positions, hoping they'll eventually recover. It's kind of like holding onto a chipped, sentimental vase because you remember how much you paid for it, even though it's now just collecting dust and taking up space. The emotional cost of admitting a mistake feels too high.
So the very fear of accepting a loss can, paradoxically, lead to even greater losses down the line. It sounds like a self-sabotaging loop that's incredibly hard to break free from.
Precisely. An investor might stubbornly refuse to sell a stock that has fallen drastically, say from $150 down to $90. They're still anchoring its right value at $150 in their mind, even when fundamental market conditions for the company have changed beyond recognition. This profound reluctance to realize and accept damages can pave the way for even greater financial deterioration later on. It's not merely emotional commitment to a past decision. It's the deeply ingrained fear of loss itself, making us behave in ways that defy logical economic principles and, frankly, prolong our suffering.
Okay, anchoring bias is truly fascinating. How one initial piece of information, a single number or a past price, can weigh so heavily on our minds. It influences all subsequent decisions, even if it's completely irrelevant to the current situation. It's like our brains get stuck on that first number, unable to move past it, isn't it?
It absolutely is. Anchoring bias describes our tendency to rely too heavily on, or anchor to, a past reference point or just a single piece of information when making a decision. Studies have even shown that people are influenced by completely random numbers like digits from their birth year, when later asked to assign a value to something totally unrelated. It's as if our minds try to find comfort and a starting point in that first piece of data, no matter how arbitrary it is, using it as a mental benchmark. How does this play out in investing, where market conditions and company fundamentals are in a state of constant flux? It seems like clinging to the past would be particularly detrimental. Oh, it's particularly problematic during market fluctuations. Investors may cling stubbornly to outdated reference points, like a stock's past peak performance or its initial purchase price. They do this rather than adjusting their analysis and decisions based on current objective market conditions. So, for example, if you bought a stock at $50 and it's now trading at $30, you might anchor your perception of its true value to that original $50. That makes it incredibly difficult to make a rational decision to sell, even if the company's underlying fundamentals have fundamentally deteriorated. You're effectively judging the current reality through the distorted lens of a past memory or an arbitrary historical point.
So what concrete steps can we take to avoid being stuck in the past? To unmoor ourselves from these mental anchors and make decisions based on the present reality of the market?
Well, to effectively manage anchoring bias, investors need to regularly and systematically review their portfolio performance against current market data and established objective benchmarks, not past highs. It's crucial to establish systematic approaches for assessing investments based on multiple current indicators. And you have to deliberately focus on factual, up-to-date market conditions rather than solely on historical reference points. Objective evaluation criteria, like comparing a stock to its industry peers today, are absolutely key. It's about constantly recalibrating your mental compass to the present, not relying on an outdated map.
Overconfidence. It's a truly wonderful, intoxicating feeling, isn't it? Especially after a successful trade or two, when you feel like you've cracked the mysterious code of the market. But as our sources highlight, it can quickly become a real trap, leading us down a path of increasing risk without adequate foresight or critical self-assessment.
It's exactly what it sounds like. A belief in our own abilities and judgment that far exceeds reality. After one or two successful trades, we might start to believe, perhaps unconsciously, that we are market geniuses. We tend to attribute wins to our superior skill and foresight, and conveniently blame any losses on bad luck or external factors, right? This skewed attribution can lead to taking on increasingly more risk, trading more frequently, and straying significantly from an initial, well-thought-out investment plan because we feel invincible, almost blessed by the market gods.
And the consequences of this elevated, unchecked sense of self can be spectacular, and definitely not in a good way. History, regrettably, is full of cautionary tales, isn't it?
Indeed. Just consider the infamous 1999-2000 dot-com bubble. Many individual investors, fueled by this potent mix of excitement and overconfidence, made serious, often reckless, investments. They genuinely believed technology company stocks would rise continuously, just defying gravity. Their excessive collective confidence acted as a powerful accelerant, causing the bubble to swell to unsustainable heights. And when it inevitably exploded, they suffered truly catastrophic losses. Research from our sources confirms that extremely safe individuals believe that they predict market trends correctly and tend to make more transactions. This usually causes portfolio performance to decrease because investors take unnecessary risks. It's a classic, painful case of hubris leading to a devastating fall.
So a little humility, a healthy dose of self-skepticism can go a very long way in the market, constantly reminding us that past success, however sweet, absolutely doesn't guarantee future returns.
A lot of humility. Overconfidence is such a dangerous obstacle because it prevents us from adequately analyzing risks and conducting sufficient due diligence. It can lead to taking high-stakes positions without proper, thorough analysis, effectively setting us up for a spectacular downfall when the market inevitably, as it always does, turns. The market has an almost uncanny way of humbling even the most self-assured among us, and a deep appreciation for that reality is a powerful safeguard.
There's a deep, almost primal human comfort in being part of a crowd, isn't there? It simply feels safer to do what everyone else is doing, to move with the collective. Even if we don't fully understand the underlying rationale, it's the safety in numbers instinct, but maybe dangerously applied to investing.
That's herding behavior in its essence. It's when investors imitate the actions of others, surrendering their own independent analysis in favor of following the perceived wisdom of the majority. This is one of the most significant reasons for the formation of market bubbles and subsequent collapses. Everyone rushes in, or conversely, rushes out at the same time, amplifying price movements far beyond what fundamentals would suggest.
Can you give us some historical examples where this herding instinct had truly massive, widespread consequences for vast numbers of people?
Certainly. Prior to the 2008 mortgage crisis, individuals across the United States engaged in intensive housing purchases. They were fueled by a widespread, almost unquestioning belief that property prices would continuously increase indefinitely. This mass herd-like behavior artificially inflated prices to unsustainable levels, ultimately leading to the devastating collapse we all remember. Similarly, the meteoric rise of certain crypto assets like Dogecoin in 2021, based largely on humorous speculation and collective enthusiasm rather than any real intrinsic value, is a concrete, contemporary reflection of these behavioral patterns. As Humphrey Neal's Art of Contrary Thinking famously explains, when everyone thinks alike, everyone is wrong. It's a powerful, often irresistible social force that demands critical awareness.
And with the advent of the digital age, this herding instinct has truly gone global, operating at warp speed. It creates financial flash mobs and rapid market shifts. The scale and speed of it must be unprecedented.
Absolutely. The market became accessible to everyone at an unprecedented speed, removing many traditional barriers. Social media has become the new town square, and finfluencers are the new town criers, their messages spreading instantaneously. The herding instinct, once driven by physical crowds and word of mouth, now operates at the speed of a viral tweet or trending TikTok video. This is why a Reddit community can collectively drive a stock to absurd heights, and why an unexpected celebrity endorsement can make a cryptocurrency jump with incredible volatility. We're not just reacting to information anymore, we're reacting to each other's reactions, often without pausing for critical thought.
Okay, imagine knowing intellectually what you should do, what the smart move is, but then finding yourself doing the exact opposite. That internal conflict, that persistent mental tug of war, must be truly exhausting. It's like knowing you absolutely should eat your vegetables, but your hand keeps reaching for the cookie jar instead.
That's a perfect encapsulation of cognitive dissonance, a term coined by the psychologist Leon Festinger. It's a state of deep mental discomfort that arises from holding two conflicting beliefs, values, or attitudes simultaneously. In the realm of investing, it happens profoundly when your rational beliefs about the market, perhaps acquired through research, clash directly and uncomfortably with your actual investment actions. It causes a real stressful internal struggle.
So, knowing diversification is an absolutely fundamental bedrock principle of investing, but then having most of your money irrationally concentrated in one single stock, maybe because you're emotionally attached to it or you bought into a strong narrative.
Exactly. Or another classic example, intellectually believing in the long-term power of compounding and patient investing, but then frequently reacting to short-term market fluctuations with panic selling or impulsive buying.
Yeah.
This dissonance often stems from our deeply ingrained emotional responses and inherent biases conflicting directly with rational, established investment practices. It can lead to significant stress, unease, and an underlying sense of internal conflict as your brain desperately tries to reconcile these opposing forces.
And this internal conflict, this mental discomfort, can very quickly lead to some truly poor, erratic decision-making as we desperately try to resolve that unease.
Without a doubt. Cognitive dissonance can lead to highly erratic investment behavior and significant deviation from established, well-researched strategies. Investors seeking to alleviate that discomfort might actively change their investment strategy to align with their problematic actions, even if it's demonstrably against their own long-term best interests. This can manifest as panic selling during market downturns to stop the pain, or chasing high-risk investments without proper analysis to quickly make back losses. They might also deliberately ignore or rationalize away any conflicting information, effectively reinforcing unproductive and damaging behaviors. It's the elaborate mental gymnastics we perform to justify our less than optimal choices and regain a sense of internal harmony.
So if awareness is the first step, what does that acknowledgement truly look like in practice for an investor feeling that internal tug of war? How do we begin to resolve this deep-seated conflict?
That's a crucial question. Yes, awareness and acknowledgement are absolutely crucial first steps. Recognize the tangible presence of this internal conflict. That feeling of discomfort when your actions don't match your belief allows investors to start addressing the root causes. It's about being brutally honest with yourself about your motivations, asking, why am I really doing this?
Right.
And then consciously working to align your actions with your long-term rational goals. It's a continuous process of self-reflection and adjustment.
Right. Every generation enters the financial markets with its own unique set of experiences and influences, profoundly shaped by the world they grew up in. But Gen Z, born into a deeply digital, hyper-connected world, has a truly unique investment landscape to navigate, unlike any generation before them. They are, in many ways, pioneers in this digital finance world.
They certainly are. Gen Z investors represent a growing digitally native force making their entrance into financial markets. They are profoundly attracted by the wide, often instant dissemination of financial information on social media, the increasing ability to invest with very small amounts through user-friendly apps, the undeniable prevalence of cryptocurrency as a mainstream asset, the ever-present fear of missing out, or FOMO, and of course significant influence from parents and family. It's a really potent mix of unprecedented accessibility and often intense social pressure.
What are their primary financial goals, given this unique background? Is it all about quick wins and chasing trends, or are they also looking towards the long term, despite the instant gratification economy they inhabit?
It's a fascinating blend, actually. A CFA Institute study highlights their top financial goals. Having enough money to travel and vacation at 62%, saving for unexpected expenses, 55%, and a significant portion, 51%, are already thinking about being able to retire comfortably. What's particularly interesting is that even though retirement is many, many years away for most of them, investing Gen Zs are actively thinking about it as a goal now. It shows a nuanced blend of immediate desires for experiences and, at the same time, forward-thinking long-term planning.
And how does their risk tolerance compare to, say, older generations who might have experienced more traditional market cycles? Are they more conservative, or are they more comfortable with taking chances, perhaps influenced by the digital world's rapid pace?
Our sources indicate a distinct comfort with higher risk among a notable segment of Gen Z. Almost half of Gen Z investors, that's 45%, who report a high risk tolerance, also gamble at least monthly. Moreover, they are significantly more likely to be invested in riskier assets like crypto, 70% versus 44% for non-gamblers, NFTs, and options or derivatives. This shows a distinct comfort with, and perhaps even an appetite for, higher risk, potentially influenced by their digital environment, where narratives of quick, exponential gains are frequently showcased. There's undeniably a certain thrill-seeking, almost gamified element at play for many. Hashtag tag, 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 tag 3.2, the rise of influencers and social media.
Yeah, social media isn't just for cat videos and dance challenges anymore, is it? It's rapidly become a dominant hub for financial discussions, giving meteoric rise to finfluencers who seem to be absolutely everywhere these days offering advice.
They have indeed become a ubiquitous presence. Finfluencers provide a whole range of investment advice, budgeting tips, and economic insights on platforms like YouTube, Instagram, and especially TikTok. Now, while they certainly increase financial understanding and accessibility among younger generations, there's also a significant, often underappreciated risk of false or misleading information, speculative activity, and the amplification of herd mentality. It's truly the Wild West of financial advice, sometimes operating without the traditional gatekeepers and regulatory oversight that govern conventional financial advice.
So they really can be a double-edged sword, increasing awareness and democratizing finance on one hand, but also potentially leading people astray with unregulated or even biased advice on the other. It sounds like navigating this landscape requires a pretty sophisticated filter.
Absolutely. Our research shows that behavioral biases significantly impact Gen Z's investment decisions, and this connection is strongly mediated by finfluencers. Their narratives and recommendations can either reduce or, more often, dangerously increase the impact of these biases, sometimes pushing people towards riskier behavior. This really highlights the critical importance of digital literacy and, crucially, a highly critical approach to evaluating online financial content in investor education. It's no longer enough to just consume the content. You absolutely have to evaluate the source, their credibility, and their underlying motivations.
Right. It's not just about what information you receive, but fundamentally how you evaluate the source, rigorously checking for credibility, potential conflicts of interest, or even just a basic understanding of financial principles.
Precisely. The ethical obligation on finfluencers themselves is substantial, as their messages play a profound role in shaping the financial practices of an entire generation. This really calls for authorities to seriously consider developing explicit rules and guidelines to ensure the financial data and advice they post is not only reliable but also responsible and appropriately disclosed. There needs to be a delicate balance between accessibility and accountability in this rapidly evolving space.
Crypto seems to be the ultimate Wild West of investing, doesn't it? A dynamic realm where speculation often appears to significantly outweigh fundamental analysis. It really sounds like behavioral biases run rampant there, possibly even more intensely and rapidly than in traditional, more regulated markets.
You're spot on. Crypto money markets are uniquely and highly open to the intense effects of investor psychology. This is due to their decentralized structures, often extreme volatility, and a general lack of comprehensive regulation. Sudden, dramatic price increases and equally rapid decreases, like those witnessed in 2017 and 2021, powerfully demonstrate that price movements frequently depend heavily on investors' collective behavioral biases, far more than on traditional economic fundamentals. It's kind of a perfect storm for emotional, often irrational, decision-making where collective sentiment can instantly move billions.
Which specific biases are most prevalent in these incredibly fast-moving, often speculative, and emotionally charged crypto environments?
Well, many cognitive biases are intensely observed and amplified here. Fear of missing out, or FOMO, is arguably the most powerful. It causes investors to make sudden, impulsive, and often irrational decisions, hastily entering positions based purely on social media buzz or celebrity tweet rather than solid analysis. Herd behavior and confirmation bias also strongly influence decisions, leading investors to imitate others and sideline their own critical analysis. This causes bubbles to swell and burst at an alarming rate, much like the humorous yet financially impactful Dogecoin rise in 2021. It's incredibly easy to get swept up in the collective excitement or panic when the narrative is so strong and widely shared online.
And a 237 always-on nature of crypto markets, unlike traditional markets that have definitive closing bells, that must exacerbate the issue, right? It essentially leaves no time for emotional cooldowns or thoughtful reflection, constantly keeping investors on edge.
That's a critical point. It absolutely exacerbates the issue. While traditional markets have limited trading hours, which, by design, allows for some emotional control and time for sober reflection, the continuous, always-on nature of crypto markets weakens this essential mechanism. It forces investors into an environment where investment decisions are shaped by instant impulses and immediate reactions to real-time fluctuations. This environment profoundly underscores the crucial need for crypto investors to proactively increase their cognitive and psychological awareness, to build that mental resilience against constant, immediate, and often overwhelming digital influences. Hashtag 3.4 money dysmorphia and impulse spending.
This is a newer concept, but money dysmorphia really hits home for how social media subtly yet powerfully shapes our self-perception, even financially. It's almost like body dysmorphia, but it applies directly to your bank account and your perceived financial standing compared to others.
That's an insightful comparison. Money dysmorphia is a phenomenon where individuals develop a distorted and often unhealthy perception of their own financial situation. This is largely due to constant, often unrealistic comparisons with peers and the meticulously curated, often aspirational world they see presented on social media. The pervasive show-off culture online, where lavish lifestyles and seemingly effortless success are highlighted, contributes significantly to this unhealthy trend. It leads to persistent feelings of inadequacy and financial anxiety. You're constantly feeling like you're not doing enough or don't have enough compared to what you see.
And how does this often hidden internal feeling of inadequacy, this sense of not enough, specifically affect investing and broader financial decisions, especially for Gen Z?
Well, it can lead to profoundly irrational decision-making. On one hand, it might cause individuals to avoid investments altogether, paralyzed by a constant fear of losing money, believing they can't afford any misstep. Conversely, it can drive others to engage in extremely risky high-stakes investments, chasing a dopamine rush from quick bucks or desperately trying to catch up to the perceived wealth of their peers online. It makes it incredibly difficult for individuals to define enough for themselves, constantly pushing the financial goalposts further away based on what others appear to possess. It traps them in an endless, unsatisfying chase.
And beyond investing, impulse spending is also a huge pervasive factor for Gen Z, isn't it? Fueled powerfully by the instant gratification that digital platforms and e-commerce offer, it's a constant siren call.
It absolutely is. E-commerce portals, and ironically even some finfluencers, aggressively promote instant gratification and consumption. This often leads many Gen Zers to spend money on short-term wants rather than diligently saving for vital long-term goals. They might rationalize these spends with clever internal accounting concepts like girl math or boy math, adding more items to a cart to qualify for free shipping, or feeling like a concert ticket paid for months in advance means they're going for free on the day of the event. It's a very clever way our brains justify desires and sidestep responsible financial planning.
So how can Gen Z effectively deal with these potent feelings of inadequacy and the relentless lure of instant gratification in a world seemingly designed to encourage it?
Setting realistic personal financial goals is paramount. Goals that truly align with your values and circumstances, not someone else's highlight reel. Consciously and regularly reminding oneself that what you see on social media may not be the entire truth, that posts might be sponsored or items borrowed, or that debt often hides behind glossy facades. These are crucial protective steps. And fundamentally, accepting that everyone's financial journey is uniquely different with its own pace and challenges is the foundational first step towards setting realistic goals and finding your own sense of financial peace and contentment rather than chasing an illusion.
Amidst all this digital noise, the relentless influence, and the curated perfection online, it's truly refreshing to hear about de-influencing. It's like Gen Z is finding its own voice, actively pushing back against the tide of constant consumption and the pressure to conform. It's a very encouraging sign, I think.
It genuinely is. De-influencing, or reverse influencing, is an emergent and powerful trend where Gen Z members consciously go against the grain of popular finfluencer or consumerist advice. They're trying to discover what genuinely works for them, what truly aligns with their values. This trend is rising amid a growing and, I think, healthy distrust in finfluencers who sometimes give unregulated, generalized advice or aggressively peddle expensive courses under the guise of financial literacy. It's a very positive sign of critical thinking and discernment emerging within this generation.
So it's about being more critical, more discerning, and more actively engaged in evaluating online content rather than passively accepting what's presented as gospel.
Precisely. As one Gen Z consumer from our sources put it so well, it's important to have the right information, and social media is one of the most accessible ways right now. We should be more cognizant about what is being said, whether it's relevant, and know the pros and cons before investing our money. Some, like Reticulata mentioned in the research, even prefer to bypass finfluencers entirely and consult professional investment advisors because they simply don't have the time or expertise to thoroughly research and verify finfluencer claims. They are actively seeking out more reliable, verified, and personalized sources of wisdom.
This proactive approach, this discerning skepticism, is a powerful and essential tool for navigating the complexities of modern investing. Especially in such a volatile and opinion-saturated digital landscape, it truly speaks to a growing maturity.
It absolutely is. It fundamentally encourages critical thinking, independent verification, and the pursuit of reliable, personalized financial advice. These are all essential for making truly informed, strategic, and resilient financial decisions. It's about moving beyond surface-level recommendations and demanding substance, evidence, and genuine value from financial content. This shift from passive consumption to active, critical engagement is a game changer.
Right. Markets aren't merely driven by balance sheets, corporate earnings, and economic policies, are they? They swing wildly, almost cyclically, based on how people collectively feel. It's like a grand, predictable emotional cycle, acting like a giant, fluctuating mood ring for the entire economy.
It's a powerful observation. Excitement, greed, and over-optimism can relentlessly drive markets up, fueling even more optimism, while pessimism and fear can make investors frugal, causing prices to plummet. This cycle, as our sources show, typically repeats through distinct emotional phases. It's constantly moving from hope to fear and back again, creating both profound opportunities and treacherous pitfalls along the way.
That's fascinating. Could you walk us through some of those key emotional phases so we can maybe better recognize where we might be in the cycle, both individually and collectively?
Certainly. It often begins with optimism, as markets tentatively begin to rise after a downturn. This gradually transitions into excitement, as early gains make initial investors feel exceptionally smart. This can then escalate rapidly to euphoria, where investors feel virtually unstoppable, prices become severely overvalued, and all warnings or rational concerns are completely ignored. This is frequently when the broadest swaths of the public finally decide to enter the market, often right before a significant correction.
The point of maximum risk, ironically.
Exactly. Then the mood shifts. Comes anxiety as prices stop rising, followed by denial as markets dip. But investors desperately cling to hope that it's just a temporary blip. Fear takes over as losses accelerate, leading many to panic sell at the absolute worst possible time. This plunges into despair, the lowest point of the cycle, where regret is sky high, and some investors abandon investing entirely, vowing never to return. Finally, hope and recovery gradually return as the market finds a bottom, and confidence slowly but surely rebuilds, starting the whole cycle anew.
Recognizing the cyclical pattern, seeing the market not just as numbers but as a collective reflection of human psychology, that sounds like it could be incredibly empowering. It helps us avoid getting swept up in the extremes, offering a much-needed perspective, right?
It absolutely can. While understanding this cycle won't eliminate market risk entirely, it provides immense psychological leverage. It helps investors stay grounded, avoid impulsive reactive decisions, and invest with far more clarity and less raw emotion. It helps us see that chasing returns during euphoria or panicking during downturns are deeply human, primal reactions. But with awareness, they are entirely avoidable reactions if we can recognize the emotional phase we're in and act contrary to the crowd. It's about building emotional fortitude.
Okay, this is where it gets really interesting for me. We've talked about biases and emotions, but how much of this is actually hardwired into our biology, right down to our brain chemistry? Is there a physical, measurable basis for our financial decisions deeper than just our conscious thoughts?
That's the frontier of neurofinance, an emerging field that uses sophisticated neuroscientific techniques to analyze the precise neural processes involved in financial decision-making. Researchers employ tools like fMRI, which detects blood flow changes in activated brain regions, or EEG, which measures electrical impulses, to literally map what happens inside our brains when we make financial choices. It's truly seeing the brain in financial action.
So they can actually observe our brains making money decisions, which regions light up, how they communicate, how they react to gains or losses. That's wild, like a live map of our financial instinct.
In a fascinating way, yes. Studies reveal, for instance, that a positive, anticipatory, exciting environmental signal can measurably increase risk-taking behavior. One particular study showed that exposing subjects to pictures of their future selves can significantly enhance their ability to allocate resources to their future. It made them more likely to accept later monetary rewards over immediate ones. This suggests that patience and long-term planning can be directly influenced simply by making our future self more vivid and real to our present self.
What's particularly fascinating here is that emotions play a significant role, even for seasoned professionals and experienced traders, not just beginners. It's clearly not something you simply outgrow with experience.
That's a critical point, often misunderstood. Even professional traders exhibit emotional reactions to monetary gains and losses. It's part of being human. Experienced traders, however, tend to feel these emotional arousals to a lesser extent and, more importantly, are far more adept at regulating them. This indicates that while quick decisions based on intuition might be necessary in fast-moving markets, managing that emotional arousal, effectively processing and mitigating its impact, is absolutely crucial for consistent success. They've learned to regulate, not eliminate, their emotional responses.
And our brain's incredibly complex chemical messengers, like dopamine responsible for reward and motivation and serotonin affecting mood and stress, are deeply involved too.
Definitely. Dopamine, which drives both satisfaction and despair, profoundly affects our uncertain investment behavior. Higher levels are linked to moments of significant wins and over-optimism, while lower levels can contribute to feelings of loss and influence group psychology, pushing us towards herd behavior. Serotonin, on the other hand, which governs stress and depression, can lead to unmotivated, anxious behavior, causing premature exits from potentially profitable positions and stubborn resistance to realizing losses. It's a complex, ongoing biochemical dance that underpins our financial choices.
What about specific brain regions? Are there particular areas that consistently light up during moments of intense financial fear, or conversely, during periods of calm, rational analysis?
Yes. The amygdala, that almond-shaped emotion center deep within our brain, is the control hub for the fight-or-flight reaction. It's often the primary driver behind investor panic selling during bear markets, an ancient part of the brain designed for primal survival, now reacting to portfolio dips. The prefrontal cortex, conversely, is responsible for complex cerebral decisions, working memory, and analytical reasoning. This is the area we actively try to engage and strengthen for more rational, deliberate financial choices, helping us form inferences and make considered judgments from various market events.
And it goes even deeper. You mentioned genetic and hormonal differences can apparently influence our financial behavior, making some of us naturally more predisposed to certain risks or cautious behaviors from birth. That's a profound revelation.
It truly is. Genetic components play a significant role. For instance, individuals carrying the 7-repeat allele of the DRD4 gene are observed to take significantly more risks, sometimes 25% more than those without it. Conversely, the 5-HTTLPR allele is linked to risk aversion, with carriers taking approximately 28% less risks. Hormones like testosterone and cortisol also play a role. Studies show that higher prenatal testosterone exposure can lead to a masculinization of financial behavior and increased risk-taking in adulthood. It's clear that our inherent biology plays a surprisingly significant, often predetermining part in shaping our financial identity and our natural inclination towards risk.
So what does this all mean for us? That our financial decisions aren't just a matter of willpower, but are deeply intertwined with our very biological makeup, our individual wiring. It's a complex picture.
It means precisely that. Our individual investment choices are deeply rooted in our unique biology and can vary significantly across individuals. Now, while we may not have direct control over our genes or baseline hormone levels, understanding these underlying biological factors helps us recognize that suboptimal choices aren't character flaws. They're rather a reflection of our complex human operating system. This knowledge allows us to approach our financial habits with more self-compassion, less judgment, and crucially, to develop more effective, personalized strategies that work with our inherent nature, rather than constantly battling against it. It's about tailoring the approach to the individual. Hashtag 4.3, building a seawall against emotional decisions.
Okay, so here we are. We're navigating a market that's a collective reflection of human emotions, and our own brains are wired with biases, primal urges, and chemical signals. It sounds like a pretty tough game to win without getting completely swept away by the currents. But you mentioned building a seawall against these emotional tidal waves earlier. How do we start constructing that essential defense?
That's the critical pivot point. The solution isn't to try and fight your emotions head-on in the moment. That's like trying to stop a tidal wave with your bare hands. It's often futile. The solution, based on all our research, is to proactively build a system, a robust seawall, that protects you from your own emotional reactions. It allows your rational brain, your prefrontal cortex, to catch up with your emotional brain, the amygdala. It's about creating structures and habits that insulate you from your immediate, often destructive impulses.
What's the first, most fundamental brick in that seawall, the absolute foundation upon which all other strategies must be built?
1. Have a well-thought-out investment plan. This is absolutely fundamental, the bedrock of your financial resilience. It needs to be clear, preferably written down, and meticulously aligned with your specific financial goals, your genuine risk tolerance, and your time horizon. A clear plan acts as your anchor, helping you maintain unwavering focus on long-term objectives and preventing impulsive decisions based on short-term market movements or emotionally charged news. It's about knowing why you're investing, not just what you're investing in, allowing that purpose to guide you through turbulent times.
That's solid. Now, you've laid out the theoretical groundwork. What's a concrete, actionable step someone can take to immediately begin curbing those impulsive financial reactions, especially in our hyper-connected world where a trending stock is just a click away?
A fantastic question. This leads us neatly to two, the 30-second rule. Before you click buy on a stock you just saw explode on social media, or before making any significant emotionally charged financial decision, set a 30-second timer. Seriously, just 30 seconds. During that brief, powerful pause, ask yourself three crucial questions. Why am I buying this? Is it based on my own thorough research or just a fleeting social media post? Does this truly fit my long-term plan? Does it align with my established goals and risk profile? And finally, am I genuinely okay with this investment potentially going to zero? A quick gut check on your true risk tolerance. The simple, deliberate pause can be incredibly powerful in letting the rational brain catch up with the emotional one.
Diversification, probably the oldest, most timeless piece of advice in investing, universally championed. It's fundamental wisdom, but how does it specifically act as a part of our seawall against emotional decisions?
All right, 3. Diversify your portfolio. This isn't just about reducing risk on paper. It's a powerful psychological shield. Don't put all your eggs in one basket, as they say. By spreading your investments across different asset classes like stocks, bonds, real estate, various industries, tech, healthcare, energy, and even different countries, you inherently protect yourself from the extreme volatility and potential catastrophic failure of any single asset. Psychologically, it means you're no longer anchored or emotionally beholden to the performance of just one stock or sector. When one area dips, others might hold steady or even rise, preventing that overwhelming fear response that leads to panic selling. And low-cost index funds or ETFs can make this sophisticated strategy incredibly easy and efficient for almost anyone.
And for those who dread trying to time the market, a notoriously difficult, if not impossible feat for even professionals, there's a simple, consistent approach that builds discipline.
Absolutely. That's 4. Invest regularly through systematic investment plans, SIPs. This powerful strategy helps you invest small amounts consistently, week after week, month after month, effectively eliminating the need to agonizingly try and time the market. It leverages the power of compounding over time and, critically, dollar-cost averaging. That means you naturally buy more shares when prices are low and fewer when they are high. This process makes your investing incredibly disciplined and, most importantly, far less emotional. You're taking advantage of market fluctuations rather than constantly reacting to them with fear or greed.
Rebalancing. It sounds inherently counterintuitive when emotions are running high. It forces you to do the exact opposite of what your instincts might scream. Sell what's done well and buy what's fallen.
Indeed. That's 5. Rebalance your portfolio regularly. While it often adds to long-term returns and lowers volatility, its greatest benefit, as our sources highlight, is actually non-financial. It instills crucial discipline. Rebalancing requires you to do precisely what is emotionally uncomfortable but financially productive. Reduce your exposure to assets that have done exceptionally well, selling high, and redeploy capital into those that have done less well, buying low, to bring your portfolio back to its target allocations. It forces you to act against your emotional impulses, against greed telling you to hold winners indefinitely, and against fear telling you to avoid losers. It's a powerful, systematic override of bias. So if we pull all these strategies together, beyond all the charts, numbers, and even the complex brain science, the most important investment we can ever make isn't in a stock, a bond, or a cryptocurrency. It's really in ourselves, isn't it? In our own financial wisdom and emotional resilience. That's the profound overarching message from all our sources, leading us to 6. Cultivate financial literacy and emotional intelligence. Knowledge truly forms the essential base for taking long-term, informed, and calculated risks. But pairing financial education with robust emotional intelligence, that's the real game changer. It helps you better recognize and proactively manage your own emotions, allowing you to avoid those predictable pitfalls like crippling overconfidence or emotional overreaction to a loss. It sharpens your risk appraisal, enabling you to make quality decisions in inherently uncertain periods. It's about self-mastery in the financial arena, building a calm, clear-headed approach no matter what the market throws at you.
We often find ourselves in this relentless chase for wealth, don't we? Equating it purely with accumulating more and more money. Mistakenly thinking that more zeros in the bank account automatically equals more happiness or fulfillment. But the profound insights from sources like The Psychology of Money challenge that notion dramatically, offering a far richer, more meaningful definition.
You're absolutely right. The book powerfully emphasizes that money is just one facet of a truly rich life, just one aspect of genuine wealth. Other elements are health, the quality of our relationships, engaging in meaningful work, finding profound purpose are equally, if not more, important. The book states the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. This shifts the entire focus from mere accumulation to profound autonomy and freedom.
That's an incredibly powerful statement. It profoundly suggests that true wealth isn't merely about the size of your bank balance, but about the freedom it buys you. The freedom to choose, to control your time, to pursue what truly matters to you, to build a life on your terms.
It truly is about having the ability to do what you want, when you want, with who you want, for as long as you want. That fundamentally is truly priceless. It's often overlooked, but it is unequivocally the highest dividend money pays. It's the ultimate financial payoff, providing flexibility and control over your life. It allows you to prioritize experiences and relationships rather than just material possessions.
And the insight gleaned from interviewing elderly Americans about their most important life lessons is particularly poignant in this context. It really cuts through all the noise. What invaluable wisdom did they share?
Gerontologist Carl Pillemer, in his extensive research, interviewed 1,000 elderly Americans about the most important lessons they learned from life. And here's the kicker. Not a single person said that to be happy, you should work as hard as you can to make money, buy endless things, or strive to be wealthier than those around you. Their profound focus was on intrinsic pursuits, on nurturing relationships, cherishing experiences, and finding deep meaning and purpose in their lives. It's a powerful, sobering reminder of what truly lasts and what genuinely contributes to a life well lived versus what is merely fleeting.
It seems we often get caught up in the outward display of wealth, don't we? The flashy cars, the designer clothes, the extravagant vacations, all in an effort to keep up with the Joneses, or for Gen Z, with the meticulously curated, often unrealistic highlight reels they see on social media. We mistakenly confuse appearances for financial reality.
That is a deeply common, often destructive pitfall. Our sources wisely caution that wealth is what you don't see. Spending money to show people how much money you have is the fastest way to have less money. Consider someone driving a brand new $100,000 car. All you actually know about their wealth is that they now have $100,000 less than they did before the purchase, or perhaps $100,000 more in debt. You see the gleaming car, but you have absolutely no visibility into their actual balance sheet, their true financial health. Appearances can be profoundly deceiving.
So true wealth is quiet, often invisible, built meticulously through disciplined choices, deferred gratification, and a steadfast focus on what truly matters rather than outward show.
That's the absolute core of it. The only way to be genuinely wealthy is to actively not spend the money that you do have. It's not just the only way to accumulate wealth over time, it's the very definition of wealth itself, the money you hold, that you're not spending. The world, when you look closely, is filled with people who maintain a modest exterior, but are, in fact, truly wealthy, enjoying immense financial security. Conversely, it's also filled with people who project an image of being rich, but live perpetually at the razor's edge of insolvency, their finances held together by a thread. It's a powerful, liberating lesson in distinguishing between true financial security and mere performative spending.
This means defining enough for ourselves. What truly constitutes a fulfilling and secure life is incredibly important, rather than letting external pressures or the endless comparisons dictate our financial aspirations.
It truly is. Financial success isn't about accumulating the most money possible, but rather about having enough to live the life you genuinely desire, a life aligned with your deepest values. There's no universal one-size-fits-all approach. Your goals, your circumstances, and your definition of happiness are utterly unique, so your financial strategies should be tailored accordingly. This personal, introspective definition of enough helps you avoid the relentless, unsatisfying cycle of hedonic adaptation, that phenomena where you quickly get used to any new level of comfort or wealth, and then just crave the next thing, bigger and better, to feel the same level of happiness. It's about finding contentment and aligning your resources with your authentic values, not an externally imposed ideal. #outro.
Wow, what an illuminating deep dive into the truly fascinating world of financial psychology, especially with that crucial focus on the experiences of Gen Z. We've journeyed from ancient hardwired biases to the very modern, often overwhelming digital influences, uncovering how our brains themselves are wired for certain financial behaviors. It's a much more complex and human picture than just looking at a stock ticker, isn't it?
Indeed. We've seen that while the markets are complex and our minds are often our own worst enemies in financial matters, we are absolutely not powerless. By understanding these profound psychological principles like the insidious nature of confirmation bias, the powerful pull of loss aversion, the sticky trap of anchoring, and the undeniable force of hurting, you are now empowered. You can start making more conscious, strategic, and resilient financial decisions. You can build that internal seawall against an often unpredictable and emotionally charged world.
And for our incredible Gen Z listeners, it's abundantly clear that navigating this age of finfluencers, highly volatile crypto markets, and the pervasive effects of money dysmorphia, well, it requires not just smart strategies, but also a deep, honest understanding of yourself. Understanding how these powerful external forces are constantly trying to shape your internal financial world, it's really a call to self-awareness.
Remember, the ultimate goal isn't to somehow eliminate emotion from your financial life. That's impossible and, frankly, probably undesirable. Instead, it's about learning to channel those emotions effectively, using them as signals, not as masters. Use the excitement you feel when learning about a new company as motivation to do thorough, independent research. Use the anxiety of a market downturn to remind yourself of your long-term plan and your established seawall strategies. Let your emotions be your compass, guiding your actions, rather than the wild waves dictating them.
So here's something truly provocative for you to mull over as you go about your week, something to truly invest in. The most important investment you can ever make. It's not in a stock or a cryptocurrency, no matter how promising. It's in understanding yourself, your unique biases, your emotional triggers, your true values, and what genuinely makes you feel wealthy and fulfilled.
This profound self-understanding empowers you to build a financial future that is not only secure and resilient, but also deeply fulfilling, one that truly reflects your unique goals and values rather than being constantly swayed by external pressures or internal biases. It's about designing a financial life by conscious choice, not by unconscious default.
We sincerely hope this deep dive has given you clarity, motivation, and the certainty that financial psychology offers truly practical and accessible solutions for everyone. If you found this discussion valuable, please share it with someone who might benefit, leave us a comment, and join our growing community of curious learners.
Your engagement absolutely fuels these deep dives, and we truly value your insights. Until next time, be well and invest wisely, always by investing in yourself first.
Thank you for joining us on the deep dive. We look forward to exploring another stack of sources with you very soon.